The acquisition and payment cycle is a crucial aspect of any business operation. It encompasses the process of obtaining goods and services and the subsequent payment for these acquisitions. This cycle begins with the initiation of a purchase requisition and culminates in the recording of the payment. A thorough understanding of this cycle is essential for auditors. Auditing this cycle involves a systematic examination of the transactions within it. This examination is performed to obtain reasonable assurance about the accuracy and fairness of the financial statements. Auditors assess the risks of material misstatement. They also design and perform audit procedures to obtain sufficient appropriate audit evidence. This essay delves into the intricacies of the acquisition and payment cycle. We will explore the significant accounts and disclosures, inherent risks, and potential fraud indicators within this cycle. We will also discuss the auditor's role in identifying and responding to these risks through effective audit procedures. By understanding the flow of transactions, key controls, and potential risks, auditors can effectively plan and execute their audit procedures to provide reasonable assurance on the fair presentation of the financial statements. This understanding is crucial for conducting a high-quality audit. Several significant accounts and disclosures are associated with the acquisition and payment cycle. These include accounts payable, inventory, cost of goods sold, and various expense accounts. Understanding these accounts and disclosures is crucial for auditors to assess the risk of material misstatement. Accounts payable. This account represents the short-term obligations a company owes to its suppliers for goods and services received but not yet paid for. The assertion of completeness is particularly relevant for accounts payable, as unrecorded liabilities can lead to an understatement of expenses and liabilities inventory. This account represents the raw materials, work in progress, and finished goods held by a company for sale or use in its operations. The assertion of valuation is critical for inventory. This is because inventory must be valued at the lower of cost or net realizable value. Cost of goods sold. This account represents the direct costs associated with producing the goods sold by a company. The assertion of accuracy is crucial for the cost of goods sold. This ensures that costs are properly allocated and recorded. In addition to these accounts, disclosures related to payment terms, significant suppliers, and any related party transactions within the acquisition and payment cycle are also important. These disclosures provide context and transparency to users of the financial statements. Auditors must assess the adequacy and accuracy of these disclosures. The acquisition and payment cycle is inherently susceptible to several risks of material misstatement. These risks arise from the volume of transactions, the involvement of multiple parties, and the potential for errors or fraud. One significant inherent risk is the risk of unrecorded liabilities. This risk arises when purchases are made but not properly recorded in the accounting system. It can occur due to errors in invoice processing, intentional omissions, or cut-off issues. Another inherent risk is the risk of inventory obsolescence. This risk is particularly relevant for companies operating in industries with rapid technological advancements or changing consumer preferences. Inventory may become obsolete quickly, requiring significant write-downs. Furthermore, the risk of unauthorized purchases poses a significant threat. This risk arises when employees make unauthorized purchases or collude with vendors to process fictitious invoices. Such activities can lead to financial losses and reputational damage. Understanding these inherent risks is crucial for auditors to effectively plan and perform their audit procedures. They should consider factors such as the nature of the business, industry trends, and the effectiveness of internal controls when assessing the risk of material misstatement.